called this Back to the Future. And the reason being will become clear in a minute, particularly with regard to US equities, where some chap called Trump seems to be setting a major tone for an awful lot of asset classes, not just US equities. We'll then look at some of the challenges to what the prevailing consensus bullish narrative is, one thing that might just change everything one way or the other. A few indicators that I look at every day. It's a common question that I get. What do you look at? What's the first thing that you look at? I know Mario Draghi said stock markets when he was president of the European Central Bank. I'll try and be a little bit more granular than that. And then a few conclusions to finish with. So, back to the future. Donald Trump is being perhaps viewed as a return to stoking the go-go glory days of the US stock market and the US economy of the 1980s. So as a film spod, and also I was really wanting a bit of a hook and a theme for this presentation, I just thought, what were the biggest box office hits in the first years of Ronald Reagan's 2 terms as president? Superman 2 in 1981, and luckily for me, given the Back to the Future theme, Back to the Future in 1985. Good to see as a James Bond fan, 4 Euros only in there, by the way, in 1981. It actually topped the UK box office that year. So those were the films that everybody wanted to see. And the biggest act in town, and of course he was a former actor, was the Gipper, Ronald Reagan, who won elections in 1884 and embarked upon a major series of tax cuts, deregulation, and growth-oriented initiatives. Stop me if you've heard that one before recently. And in fact, one of his most dramatic first acts was when the US air traffic controllers went on strike, he fired them all. He said, we'll start again. Now, whether that's going to be quite as far as Mr. Musk goes with his initiative with regard to US federal employees right now, we'll find out. But certainly there's enough commentary in the US over there at the moment to make the people think that this is indeed potentially a very exciting action replay. The US equity market seems enthused, the dollar seems enthused. Treasury market, not quite so convinced. We'll come on to the reasons that there are indeed some similarities that we've just discussed, but also some potentially sizable differences. The first one of which is that actually Reagan's reforms did contribute to a double-dip recession in the US. Now that is nothing that is in anybody's forecast right now, and if it happened I'd be intrigued to know what that might mean for US equities, but I defer to people who know a lot more about that than I do. Reagan was also starting with a government debt to GDP ratio of just 30%, not 120. Annual deficits were small, not the 7% and a bit that we've got now, and that's when the economy is going well. Interest rates were falling, albeit from a rather nerve-wracking 17 or 18%, and money supply was pretty generous, and the dollar went bananas and actually had to be devalued in 1985 by the G5 under the Plaza Accord. So we'll come back to that. And the biggest thing that we'll mention is that US equities were just a heck of a lot lower. We can debate the semantics of whether they should be so much higher than they are, but that was certainly worth bearing in mind. And overall, as you can see, Reagan's 2 terms did have their moments, and indeed the third year of his second term was the Wall Street crash. So we shouldn't necessarily take everything for granted, but overall, it was not entirely the straightforward narrative that perhaps some would lead you to believe right now. So what are the biggest challenges to the consensus narrative of the US? And I say this just as a Yorkshireman and a fully paid up member of the Awkward Squad. I do like to generally stress test what people are telling me. And so thinking about it in terms of the US, where we've already touched upon the first one, the federal deficit, debt to a GDP of 120%, annual deficit of 7% when the economy is going well. So if the economy, for any unexpected reason, stops going well, and tax revenues go down and welfare payments go up, regardless of what Mr. Musk is trying to do, that could be a bit uncomfortable. The second one is interest rates. I mentioned that the Fed had got interest rates up to around 18% to crush inflation. That worked incredibly well. At least the direction of travel was clear. It was pretty much straight down for most of the decade. Whether it's quite so clear this time around or not, I'm not totally sure. The Fed, having galloped off like a greyhound out of trap 1 last year, now seems to have paused a little bit and seems a little bit unsure as to what to do. So again, there is an additional potential complication there. And this is the biggest one. Again, I'm going to leave this to Craig because as a global equity fund manager, he's a lot closer to individual stocks and valuations than I am. But this is the one that does leave me a little bit nervous. When Reagan took over, the US stock market was on a PE of 8. It's now on a PE of, knocking 30. Now, I know there are legitimate reasons for arguing that America is a different place from where it was then, and I get it. Knowledge-based economy, intangible assets, not tangible ones, not relying on making steel in Cleveland, and all of those things, I completely get it. And there are some phenomenal companies in the US right now. I suspect some of which I know some of them are in Alliance Witten's top 10 that really are champions and kings of the world. But whether that's necessarily something that I feel entirely comfortable with I'm not totally sure. Again, as somebody, though, I must confess, was trained as a value investor, and it's been a pretty tough sled for most of the last 30 years, I can assure you. But the one thing that could really change everything is the mighty dollar. The dollar has been very, very welcoming of Trump's second electoral victory. And we'll just come back to that, because it was if you look at the top right here, then the DXY index, a trade-weighted basket for the dollar comparison, initially welcomed Trump, and then kind of took a bit of a swan dive, partly because he spent a lot of time hectoring the US Federal Reserve for interest rate cuts. We must acknowledge that from an equity perspective, it was America first and the rest nowhere in his first term, and that is still very much the consensus now. Treasury yields actually went up, and then, okay, the collapse at the end is COVID. I don't think we can pin that on Trump, regardless of whether he's got some exotic views on that or not. And gold did pretty well, and all right, Bitcoin went bananas, again, right at the very end because of COVID. But it's worth bearing in mind that markets were somewhat suspicious of Donald J. Trump when he first won in 2016, and then actually were one round. And ultimately, he turned out to be really good for equities, a bit average for the dollar, and a bit average for bonds. So again, being the sort of perverse person that I am, I'm wondering, well, I wonder this time, if you get that recession, well, whether it's his fault or not, that won't be good for equities. If he really does cut government spending, then that will be good for bonds, not bad. And the dollar, well, this comes back to trade flows. Now, obviously, with tariffs, he's looking to try and make America great again and get as much domestic production going as possible. And there is a logical fear, based on the experience of the 1930s and the Smoot-Hawley Tariff Act, that made a difficult situation worse, that if global trade flows take a hit, that might not be a good thing for too many of us, and certainly for corporate earnings. Right now, according to the CPB, global trade flow growth is pretty good, and that is a very, very encouraging thing. So global free traders will view that as a case of long may it continue. What's really fascinating about Trump and his trade policies is his desire to try and get this US trade deficit down. Now, America hasn't run a trade surplus since 1975, so he's got a bit of history to overcome there. And in fact, he did actually knock a little bit of a hole in it, and certainly the US deficit with China came down during his first term. But there is a theory named after Professor Robert Triffin, and it's the Triffin Dilemma, a book he wrote in the 1960s, which is, this could be tricky, because the dollar is the world's reserve currency. So in the end, global liquidity rests upon greenbacks, whether that's economics or whether it's financial markets. So if Trump really does start to reduce that US trade deficit, there are fewer dollars flowing out and more dollars staying in America. Well, that's not good. That's the global reserve currency. That's the green grease upon which we all rely. And if you look at previous really strong dollar runs, they've generally caused quite a lot of dislocation. And that big spike there in the early 80s is the one I referred to, which was in the end ended by the G5 Plows record of 85. The world just couldn't stand a dollar that strong. It's inherently disinflationary because it makes commodities more expensive for non-dollar users, as we'll see in a second. And it certainly makes life very unpleasant for emerging markets, because particularly for those who borrowed in dollars, it makes servicing that debt much more expensive. And that's been one of the reasons why recently emerging markets have been finding it a little bit tougher. So oddly enough, if Trump succeeds in one of his biggest policies to erase that trade deficit, some potentially quite tricky things could happen. The good news for the moment, oddly enough, is that the dollar started going down again because of worries over a little bit over US growth. But oddly enough, this is the one potential game changer. You know, if you're looking for kryptonite, for the Superman 2 theme, this is it. And here we go. Dollar and the commodities generally have a relatively inverse relationship, though it's actually not been quite so discombobulated recently. And again, dollar in emerging markets just don't like a strong dollar. So again, if you start to see the dollar weaken, if history is any guide, and this is not investment advice, emerging markets might be of some interest, and so might commodities, if history is any guide. But as we all know, as Buffett says, if history was a perfect guide, then librarians would be the best and richest investors. So that's a little bit of Back to the Future. This is a little bit more Back to the Future. This is a photo that I took at the Peterson Museum in Los Angeles, and it is the Michael J. Fox DeLorean from the 1985 film Back to the Future. It's even set to 26th of October 1985, so if you're a film spod, this is indeed desperately interesting. I could have also shown you the Batmobile, James Bond's white Toyota from You Only Live Twice, and goodness knows what else, but this fits with the Back to the Future theme. So what am I looking for in terms of working out what's going to happen in terms of those Trump policies? Because like him or loathe him, we can't ignore him, and he is having a major influence. So from a macro perspective, and this does by not means any necessarily means filter straight directly into successful stock selection, sometimes quite the opposite. But these are things that I look at. The first one is Dr. Copper, great guide to global economic health. What? Hence the nickname. Why? Well, it's malleable, it's conductive, it's ductile, it's used in everything from kettles to cars to construction to grid infrastructure. So the better copper does, the more relaxed we can be about the global economy. It's doing okay. It's not gone through the floorboards, it's not gone anywhere for a while, but it's actually, there's probably a bit of a trend upwards there gently, and we'll take that, which given the concerns of the Chinese economy, a huge consumer, probably isn't a bad thing. Small caps. Very plugged into their local economy, generally tend to have a narrower breadth in terms of geography, management, products and service range, sensitive therefore to the local goings on. Again, intriguing to see the Russell 2000 finally having a bit of a dash at it, and even the much maligned FTSE small cap isn't doing too badly, though they're not back where they were in 2021, which suggests there are still some question marks to answer. Transport stocks, planes, trucks, rail, good stuff. I mean, Warren Buffett's rail operations are going gangbusters, as we saw from Berkshire Hathaway's results over the weekend. But this is Dow theory, Robert Ray's Dow theory. If the transports are doing well, the industrials have to be doing well. On balance, the economy is doing well. Why? Well, if an industrial company manufactures and sells something, then the shelf has to be replenished. Those goods have to be shipped and put back on the shelf, which is good for planes, trains, and automobiles. So it's worth looking at the Dow Jones Transport Index. It does tend to lead the Dow Jones Industrials. It's doing okay. It's not necessarily going bananas, but there was a nasty downtrend in 22 that it's shaken off, which you would view as a good thing, and that was obviously when interest rates were going up quite sharply in the US. Silicon chip stocks. I used to cover these at an investment bank for 12 years, so they're very close to my heart in many ways. I'm not as close to them as I used to be, but they're always a pretty good indicator. And I remember the SOX index, the Philadelphia Semiconductor Index, it peaked before the US stock market did in 2000 and 2007, and it troughed before the US stock market did in 2003 and 2009. So it's a pretty good indicator for overall market risk appetite. They are momentum jockey stocks extraordinaire, thrive off upgrades, recoil from downgrades. And they're also, because it's a $600 billion global industry, that's again ubiquitous. Silicon chips are in everything from your smartphone to your server to your car to your smart fridge to your smart meter. They are everywhere. So again, they're not only a good guide to global risk appetite, they're a pretty good guide to global economic growth. So the SOX index, 30 of the world's biggest silicon chip companies, I look at it a lot. It has just run out of puff. But I think that's possibly a valuation issue, not rather necessarily an economic issue, but I will be watching both very, very closely. We've already talked about commodities. The CRB Commodities Index, this is the grey line. If the grey line is going up, commodities are outperforming US equities, and if the grey line is going down, US equities are outperforming. I thought in 2022, hang on a minute, value investor heaven, you've got a little bit of inflation here, and actually commodity stocks are off to the races. Yeah. Didn't last very long, because I think, again, there was a feel that the US Federal Reserve has got inflation back in its basket. That feeling maybe is slightly wobbling a little bit at the moment. Again, Fed seems a bit indecisive, cut very sharply, now it's stopped, and maybe that's why gold is doing well. There are lots of theories as to why gold's doing well. Hedge against inflation, hedge against fiscal policy error, hedge against monetary policy error, hedge against Trump doing something geopolitically undesirable. Stories of physical gold being in shortage because there's so many derivatives being written against it that paper gold is now under duress because people are starting to call it the physical gold. Whatever it is, it's doing well, which doesn't fit entirely with the bullish narrative. And if I was forced to guess, I'd probably say it's a bit of an incipient inflation worry, but it may also be down to that rampant, galloping US government deficit and fears that, again, how on earth is America going to deal with that? So this is just based on the questions that one of my jobs is I talk to the print press a lot and broadcast media, as well as customers and clients. And again, this is really based on Sir John Templeton's old maxim that, bull markets start on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So again, it's a bit of a cheat's way of being a value investor, really. And so I base it on, well, what am I getting questions about? I didn't get any questions on Japan for 8 years until last year. Surprise, surprise, it just gone up rather a lot. Mood tends to follow price. So again, being one of the awkward squad, I'm more interested in what people aren't talking to me about than what they are. Nobody was talking to me about gold last year. Hasn't stopped it. Nobody was talking to me about UK banks last year, even though they're all trading at less than book value, and the index is up 60% in the last 12 months. It's the best performing sector in the UK. So I am naturally more predisposed towards talking about things that people aren't looking at rather than things that they are. So what are people not banging on about? Well, there's a bit of banging about China now, but not very much. Precious metal, not really. Oil, no, not at all. Small caps, no. Skepticism, no. Nobody's interested in emerging markets or miners or UK equities a bit more because it's doing okay. Lots of optimism on corporate debt and spreads are very narrow. Lots of talk about defense stocks. Lots of talk about the dollar in the US. And then lots of enthusiasm for the stuff in the left-hand corner, which, let's face it, is still doing pretty well, thank you very much. But if I asked you, over the last 12 months, if you had a 50-50 portfolio in 10-year bonds in a country, and they just then followed the local headline index, and we looked at the US, we looked at Brazil, China, we looked at the UK, Germany, where do you think did best? Germany. It's kneecapped itself with its energy policies. It's obviously its politics have been under serious question at least until the weekend. Germany was best, and everybody kept on telling me it was a sick man of Europe. China was second, real estate bust, lots to worry about. US was third, not bad. UK not far behind it. So again, from my value perspective, but I'm doing this from 30,000 feet, not from the granular level that the experts will be talking to you about soon. The cave that you fear to enter holds the treasure that you seek. If something's cheap enough and there's a little bit of balance sheet back in there, you're generally okay. China still worries me because ultimately China is run for the benefit of the Chinese Communist Party to stay in power, not for the benefit of shareholders. So that does niggle me. But at the moment, at least, their interests are aligned with those of shareholders because they need growth and they need the economy to hang on in there. So there might be a little bit more alignment than there would be normally, which is something to at least bear in mind. But I wouldn't go overboard on Chinese corporate governance, and I would want to be paying low multiples to compensate myself for that. So in conclusion, with 2 minutes, 45 seconds left, the US economy is continuing to do better than expected, and long may that continue because it is in the end the world's economic engine. Trump's reforms are expected to do great things. Maybe they will, but I think given that the US is now, what, 65, 70% of global market cap, I think from an investor's perspective, America is already great. And it might be quite hard for him to make things even better than they are, particularly when valuations, at least looking at it from my perspective, are quite lofty by history. The biggest consensus trade I can think of right now is the dollar, which, again, therefore, it would probably do us all good if that's wrong because of the Triffin dilemma. And the unloved stuff, like the UK, dare I say, like gold, European equities, are actually doing better than some might think now, which is kind of interesting. We still don't know whether what's coming out of the woodwork, the ultimate end game, is it inflation, stagflation, or deflation? It can't be deflation. We can't afford it. There's too much debt in the system. So it's a matter of how do central banks keep that going. Maybe that's why gold's doing well, I don't know. And if there is a major regime change coming, for the last 15 years we have had, generally, low growth, low inflation, low rates. We all know what's worked really well as a result. Long duration assets, bonds, tech, biotech. If that's now changing, because we've had COVID, a supply shock, policy error, Trump, whatever it happens to be, gold and commodities are probably going to be the tell because they're the things that really, certainly commodities have been completely in the doghouse and with emerging markets not too far behind. So if the water's going to start changing temperature, they might be the ways that we spot it first. So thank you very much for your time. That was a whirlwind 90 minutes.